All right, everybody. So let's have a little discussion about intraday trading. What we want to talk about today is often referred to as, quote, what we watch and why. So I think in the sentence, it pretty much says it all. What are we watching through the trading day, and why do we watch those things? One of the things that we want to start with in this discussion is it really doesn't matter what you're trading on the intraday. You could be looking at something like the bonds, or maybe you're trading in SPY, or maybe maybe it's Wednesday and you're trying to trade the oil report using USO. No matter what product, equities, ETFs, the futures, the micros, the minis, it really doesn't matter if you're trading options or stock or futures. If you're intraday trading, you've got to look at more than just the thing that you're trading. None of these markets move by themselves unless you're trading a specific thing. If you're trading earnings, then the earnings announcement is going to directly affect that one stock, and it's not going to affect the other stocks per se, right? Or say when Boeing had airplanes falling out of the sky, killing entire families, their stock moved because of that news. And it didn't matter what SPY or the Qs or anything else was doing that day. It didn't matter about the bonds or the dollar. Boeing was only moving based on that news. Even just recently with Twitter, there was a takeover by Elon Musk. There's a lot of news on this, and it was responding to that news. It was on Twitter, about Twitter, and the price action that we saw on a day-to-day basis was solely and directly connected to that news. On those kind of specific situations, the individual stock that you're trying to trade will be solely dependent on that event. If it's anything else, if it's just a regular day and you're just trading bullish price action or bearish action, you're having a good day, maybe it's an FOMC day, just a regular day in the market. If it's any other thing other than a direct news event, then the entirety of the market is in some way correlated and connected to another market. So if you're trying to trade Facebook, say you're bullish, you want to go in, you're trying to find opportunities to trade this on an intraday basis, Facebook alone isn't all that you would want to look at, because Facebook won't move by itself. It will move in relation with the rest of its peer group. At the very least, other firms that are social media and advertising. Also, maybe the communications sector, XLC. Possibly even the other Fang names, which I would argue maybe Facebook isn't a Fang name anymore, but either way, it wouldn't move by itself. Okay, so if you're trying to trade SPY, well, SPY is an ETF, and an ETF is a basket of stocks. It represents the S&P 500. This thing represents 500 companies. If those companies go up or down, they are likely to have some impact within SPY. Now, obviously, the mega cap names like Apple and Microsoft and Amazon and Tesla, they will have much more weighted impact than something like, I don't know, Visa, Verizon, Caterpillar. So this market, if I was trying to trade it, I would want to find as much information about what's going on as I possibly could. I'd want to know what's going on in the overall marketplace, because SPY is only one part of that marketplace. And that leads us into what we watch and why we watch it. So one of the things that we want to start with in that discussion is indexes. So the S&P 500, that's an index. The NASDAQ 100 is the NASDAQ index. There's the Russell index, gold index, bond index, volatility index, the dollar index. Okay, all these different indexes are a representation of their part of the marketplace. And when we start looking at all of these different indexes, then we have a really, really good idea of what's going on in the overall marketplace. When I was referring earlier to everything being connected, the connection's not always in the same direction, right? We can be inversely correlated. So that's just a really fancy way of saying, like a teeter-totter, that one side goes up, the other side goes down, or vice versa. We don't always know who's in the lead. Sometimes our day is greatly affected by technology. Other days it's finance or energy, small caps. We don't know, which is why we go look. Generally speaking, throughout history, bonds tend to run opposite of the marketplace. So if we're looking at something like bonds and they are sitting at an intraday low and begin to rally, we want to take a look at the market and see if we're sitting at an intraday high and are beginning to fall, which, for an example, is what happened Friday. Friday we had that nice little bump in the S&P futures by around 9:45 in the morning, and in the bonds we had just started the rally at 9:15, right? So in the bonds we had that rally to the upside, and by 10 a.m. that rally was complete. Well, by 10 a.m. the S&P had started to roll over and go down. And at that point in time, we had stocks and bonds moving in the same direction, which was negative. Then the bonds quit moving. They didn't go up. They didn't go down. They just really quit having any impact at all, while at the same time our market just kept falling and falling and falling and falling. So what else was happening through that time frame? Well, in the later part of the day, when things started to get really ugly, we had a massive sell-off in gold. We had a huge liquidation break in the Bitcoin. We had the dollar break and start moving to the downside. We had energy break and start moving to the downside. We literally had every single market out there moving to the downside. And I had people say on Friday, well, I just didn't trust the move. I kept thinking that it was a fake out, or that it had already gone so far that there was no way it could go farther from here, and they just sat and watched it run. Or even worse, they kept trying to go up against the market, trying to catch that falling knife. When every single market we're looking at here was going down. The only market that went up is the volatility market. And that's what it's supposed to do when the market falls. The volatility market goes up. So we had confirming signals from every index, from the New York Stock Exchange to the NASDAQ to the Russell, the Dow, gold, oil, bonds, the dollar. Everything was falling. Every sector, every industry, every company, every name, everything fell. But if you were only watching your one single stock, and it seemed like your stock was oversold and was near a bounce, or that it had gone so far it needed to mean revert, you didn't have enough perspective. So what we watch and why? We watch the indexes. Now there's a lot to the indexes that needs to be learned, and this is definitely not the video for it. I could spend hours just talking about the indexes. But now you know that you need to research those indexes. Some are cash cap weighed, and that makes them different. So, the distinction, for an example, between the Dow Jones Industrial Average and the S&P Standard & Poor's, there's a complete and utter difference in those two markets, in those two indexes. Absolutely want to understand those. You want to grasp the logic of the different volatilities that are out there. The Russell has a volatility index, the Nasdaq has a volatility index, and the S&P has one. Of course, the S&P's is the most popular, but that doesn't mean that the other ones aren't useful. So you can put that on your list, go in and begin learning about the different indexes out there, what they are, how they should normally move in relation with the rest of the market. And for the bonds, I can give you a little tip that it's generally speaking, it's the 10-year bonds or the 30-year bonds that most people like to watch if they're looking at futures. If you are on a broker that doesn't offer futures data, you can use something like TLT, the 20-year, which is really weird. It splits the difference between the 10 and the 30. I think it was a sorry attempt at trying to please everybody, right? Because some people were saying they wanted the 10-year as an ETF, and some were arguing that they wanted the 30-year as an ETF, and so they tried to please everybody by putting it in the middle, which effectively just disappointed everybody equally. So I guess that's fair. So the 30-year, the ZB, it's generally what I watch, but I mean, there's points in time that I like the 10. But now you've got a list of things to go dig deeper into, the indexes. So what else do we watch and why do we watch it? Well, another thing that we like to watch are the sectors. Now, generally speaking, there are 11 legacy sectors that belong to the marketplace. And by legacy, I mean they've been around forever. They are the standard, the norm. But we just watch these 9 more often than the entire 11. Okay. The top 3 are what we call a risk-on, the risk-on sectors. The bottom 3 are the risk-off sectors, and the 3 in the middle are what we term the midline sectors. So to kind of game it out a little bit, if you're a fund manager and your starting fund allocation is $100,000, and somebody comes to you, they give you their $100,000, and you take their money and you invest it. Well, a lot of that investment is going to be, quote, safe investment. It will be in things like staples and healthcare, utilities, because those are considered markets that would do good, all the time. Healthcare, right? People are going to use healthcare whether they have a good economy or a bad economy, right? They're going to turn on their stoves and cook. They're going to run their air conditioners. They're going to run their heaters. So natural gas and utilities, those things are going to be used no matter what kind of marketplace we have. And then staples, right? Food. People are going to buy food. Doesn't matter what kind of economy we have, they're going to buy food. And so those kind of markets are considered to be, boring, slow, safe, low volatility kind of marketplaces. And that's also what we deem a risk-off marketplace. When the market's bearish and it's against tech and it's against finance and it's going down, well, where do people trade on a day like that? They go into safer, quote, safer markets. But why did I bring up the allocation in the $100,000? Well, in a really bad market, and not just a market, but in a really bad economy, say we're entering into a bear market and there's an economic recession, say like the '08 housing crisis, people are worried about their investments in the marketplace and they no longer want to trust the guy that they gave $100,000 to. And they say, hey, I want my money back. I want to go ahead and cash out of your fund, wherever we happen to be at. Cash me out. Well, that's called running a redemption. So if the guy has to give people their money back, he has to sell something to give them their money back because he doesn't have their capital just sitting around in the bank. He put it to work. He invested it. If he wants to give them their money back, then he has to diverge of those investments. He has to sell something. What's he selling? The safe stuff that is supposed to be good in a downward market. He's selling staples and utilities and healthcare. So those are markets that we expect to do good in bad times, unless things get really, really bad, right? Then they're going to go down, which is why we keep track of it. Because if we have, like Friday, every single market going down, I mean, everything was going down, then it shows it's not just price action for today. People were running redemptions on the firms. They were telling those people, hey, never mind, cash me out. This is starting to get really bad. Right? And we've seen those redemptions also in things like gold during the COVID crash. Gold's supposed to be a safe haven asset against inflation. And yesterday we saw gold going down hardcore. Well, you can't think that inflation has suddenly ended and that people don't need the hedge anymore. Why was gold going down? People were selling everything yesterday. It didn't matter. There was no safe place. So we want to look at these sectors on a day-to-day basis and ask, are we on a risk-on environment or are we in a risk-off environment, a midline environment? But we also look at them at the end of the day, and we look at them at the start of the day before the morning has even progressed very far. We want to know, where are we starting on the day? Is it a red to green setup, a trendline breakover, an IX10? What do we got? And then as the day unfolds, are we having an inside day breakout? So for an example, in industrials yesterday, we opened up relatively well, slightly gapped down, and then we fell through the day and had an inside day breakout of an IX10 pattern. It was just a little more confirmation of the move on the day. And we had that agreement or that perspective that, yep, everything's burning. Right? So the 9 sectors, those sectors can be identified on Thinkorswim. If you wanted to look at the S&P sectors, there's a watch list already made for you. Let me just detach a watch. Well, I'll make a new one. So I want to make one because I want to show you not only where to find it, but how to fix it so that you can read it. See, there's these different national tags that are used for the sectors. And the tags really don't make much sense. So if we go in and say, ask the machine to show us the S&P sectors, what we're going to get is a bunch of tags. Look at these tags. It says SP500 hashtag number 25. What the hell is that? I don't know what that is. Do you know what that is? And of course, no, you don't know what that is. So we need to fix that. How do we fix that? Well, we ask the machine to give us a description. With the description, we can now remove the symbol. And the symbol is that funny little SP500 hashtag number 10 or whatever, right? So let's go in and remove the symbol and just keep the description. And now we have a much better idea of what we're looking at. It says energy and materials and industrials and consumer discretionary. So it names those sectors by name, and now we can see, oh, okay, that's where the sectors are. Now, if I went through the watch list too fast and you didn't see how I got that, go in. They're alphabetized where it says public. That tells you that those are pre-built on your Thinkorswim platform, and they're in alphabetical order, and we want the S&P, so we come down to public S through W. And then we look at sector indices. Now, if you were to go to sectors and industries, you'll get a lot more names, okay? You'll get a lot more names, but they'll still have that funny little tag, and you'll have to put a name to them, so the description will come in really handy for you on that, too. We just want to look at the S&P sector indices, and that are these, right? These are these charts right here. That's what we're looking at, okay? What I don't have showing on there is real estate and communication services, but otherwise, the other 9 are there, okay? And we would use these for that risk-on, risk-off sentiment. In a good bullish market, you have to have technology or finance, or both. Both is great. Right? But you cannot see a rally in the S&P and the NASDAQ on a day-to-day basis if you don't have at least one of those 2 sectors, which is part of the reason we call them the risk-on sector, but it's also why we have those 3 categorized, right? So XLY, which is what I consider frivolous household spending. That's Starbucks, it's Tesla, it's casinos, cruise lines, resort hotels. And then there's technology and finance. When you have all 3 of those doing really good on the day, you're very likely to see a rally in the S&P and the NASDAQ. But if you have those doing really bad on the day, you are not going to see a rally in the S&P and the NASDAQ. So again, very useful on a day-to-day basis for what we watch and why we watch it. You now have a really great place to continue digging deeper into this, right? Because in one video, I just don't have enough bandwidth to spend an hour or two talking about the sectors, but I could, and it would be very useful, right? There's a lot of information here, and we want to look at them not only intraday, but we want to analyze them after the market is closed for the day, and we want to look at them in the mornings before the market opens up. Those higher time frames where I have my chart set right now, but also the lower time frames during the day, right? Where are we on the day, and are we moving, in sync with the rest of the markets? So what else do we watch, and why do we watch it? On Thinkorswim, we have these old school indicators, and these old school indicators have been around for a long, long time. We're talking about things like the New York Stock Exchange tick, or the up volume versus the down volume in the New York Stock Exchange. So there's advancing and declining issues, there's advancing and declining volume, there's tick, put call ratio. There's all kinds of things out there that are just market indicators, right? And that's why the label even says right there, indicators. Now, these old school indicators are useful for a variety of things. How many markets are making new highs? How many markets are making new lows? That kind of thing. So there's all kinds of values in all kinds of different markets. One of the most popular out there is $sign, which is how you tell Thinkorswim that you want to look at an indicator, a market breadth indicator. $sign TICK. This is the New York Stock Exchange tick. Now, I've done articles and blog posts on this. There's a lot of books and videos and webinars and presentations, and every single index has a tick. So the NASDAQ has a tick, the S&P has a tick, the Russell has a tick, but for some reason those are not as popular as the NYSE tick. And so even though we may be trying to trade the S&P or the NASDAQ, we still want to look at the tick. So without my drawings on there, we're just looking at price action here, what you can see is a mess, right? But it's a range-bound mess. It runs from 1,000 to minus 1,000, and then there are random spikes that go a little bit beyond that. Now, we're not going to get into the why and the when of all of this thing. I could spend 2 hours talking about tick. But if you use your drawing tool and you put a line at 0, and then you monitor where the market is on a day-to-day or an hour-to-hour or even a minute-by-minute basis, you'll see where we maintain positions below the 0 line in a negative market territory, or we maintain positions above the 0 line in a positive market territory. And through the day, when the ticks hit extremes, we'll see pauses in the overall marketplace. Like the S&P will stop advancing, it'll end a rally and just pause, or it will reverse there and actually start going in the other direction. So tick through the day, really, really useful. But we want to go beyond just tick, because there's what's called a cumulative tick. And cumulative tick is a pretty useful tool from a variety of different ways, but it's basically taking each one of those tick candles and adding or subtracting it from the last candle. It cumulates. So for an example, on Friday, we opened up just at 0. I believe the very first tick was at 1, slightly above 0. But through the day, it just maintained this bearish posture, getting more and more and more negative on the day. And if you was to compare this with different days, then you have a gauge on how negative is today's negative day, right? Like on a day-to-day basis, or when we're range-bound and we're having kind of a sideways day and nothing's really popping and then things really start kicking off, we can use this to kind of gauge how aggressive is things getting out there. When it's bullish, we have a good perspective of that bullish per day too, right? So cumulative tick. Now obviously there's a lot more to tick and cumulative tick. This isn't really the format for it. I'm just discussing what we watch and why we watch it. The how and the why of each one of these different products would have to be something that you would dig into in much greater detail. So this one that we're looking at now with these 4 different lines, well, this isn't just the cumulative tick of the NYSE, which is what we were looking at down here. That's the cumulative tick of the NYSE. Now we're looking at the cumulative tick for 4 different indexes. Now, since the Dow is a different kind of index, it's not on this list. What we have instead is the NYSE, the New York Stock Exchange. We have the Russell, the NASDAQ, and the S&P. And we look at all 4 of those cumulative ticks combined. The dots at the top show when all 4 are moving together to the downside, and the green dots at the top show when all 4 are moving together to the upside. Because if you think about it, if every single sector is bidding up at the same time, well, that gives you a lot of information. And if all of the markets are bidding down at the same time, that too gives you a lot of information. And when it continues to bid down and just getting worse and worse, and the speed or the slope continues to stay aggressive and continues to move in that particular single direction, it offers perspectives and context on the day. So what we watch and why we watch it involves the cumulative tick comparison and the cumulative tick and tick itself, right? So one grid that I like to use for that is this grid. On this grid, I can see the S&P through the SPX. I can see the NASDAQ through the index. I can see the tick just reading its value. I can see the tick turned into a line chart here rather than those candles. And I can see the cumulative tick in comparison to its peers. But then we have something called the advance versus the decline. The ADS-PD is the advance versus the decline of the S&P. So the S&P has 500 products. That means we can't have more than 500 products advancing. We can't have more than 500 products declining. And if we go in and use our drawing tools, we can actually first mark the 0 line, and then we can ask through the day how many companies are advancing versus how many are declining. And is it getting better out there, or are things just getting a lot worse out there? Are we in a highly correlated market state, or are we in a low correlated market state? Now again, this isn't the format to really have a webinar presentation on advancing versus the declining issues, but I do want to point out that we want to use that. We want to look at that and have a really good idea of what's going on out there. Are things getting worse? So for an example on Friday, remember what Friday looked like? No, well, let's go back and look at SPY real quick. This was the market on Friday. The S&P SPY closed on the day down 3.7%. And it was lower than that going into the close, but it rallied back up at the last moment. So we fell a long way Friday. It was a negative day. What was going on in the advancing versus the declining issues of the S&P 500? We had 478 going into the close. That was minus 478. Now remember, this isn't saying how many names were declining. And this isn't saying how many names were advancing. This is taking how many was declining versus how many was advancing. If you just want advancing, well, they have that, right? You can go in to indicators and you can scroll down to S&P advancing issues. That way you're not looking at advanced versus decline, you're only looking at advancing issues. So on Friday, how many companies, which are issues, how many are advancing? only 13 companies were advancing out of 500 companies. Right? So on Friday, it was negative. How many companies were advancing going into the later part of the afternoon? 13 names. So 487 companies were going down Friday afternoon. Remember how I talked about when you're trading Facebook or Apple or Amazon or whatever you're trading, you want to look at what's going on around you because it's very likely going to be connected to the rest of the marketplace. Well, if 500 companies are in the S&P 500 and 487 of those are all going down at the same time, wouldn't that provide some insight to you? Give you an idea of what's happening in the market around you. So the advancing versus the declining issues in the S&P, we can do the same thing in the NASDAQ 100. Now this one is smaller because it's only 100 companies, where the S&P has 500 companies. There is an S&P 100, but unfortunately we don't have an advance versus decline for the 100. We only have it for a 500. Thinkorswim, however, does have Market Watch with a Visualize tab. And if you go in and pick your index in this thing, you can choose the S&P 100, which I really love that. Right now, this is the advancing versus, this is both. It's showing you advancing issues, it's showing you declining issues, and it's showing you how far they've advanced and declined. Well, one thing that I really like is the money flow. And that's because we always want to follow the money. So what this is telling us is going into the close on Friday, out of 100 companies, 98 of them were going down. Now, why does it say 101? Well, there's two Googles. And so technically, there's 101 names in the S&P 100, but it's Googled twice, right? Because there's GOOG and then there's GOOGL. We still would count that. I count that as just one company, but it really is two. So we could read this a little differently and say that 97 names were going down and 3 were going up going into the close, and that would give us our 100 names. But look at the money flow. Now, the way that I like to read the money flow is I just look at, I cut a couple of those zeros off, right? In my mind, when I'm trying to shortcut things, so we're just zooming here so I can tell you, this is, when I'm doing this in my own way, kind of just reading it to myself, what I do is I cut off a lot of those zeros. And what I end up with is something like that. So 11,890 or 11,922. And if that doesn't work, then I cut back a couple of more zeros. So notice how things were beginning to, or look how close they were, right? Now, let's have a little bit of context here. We don't want that one. We're just going to hide that one right off the bat. Or in fact, we'll just cut it off. Okay, so now we want to compare, and we want to be able to read it the fastest way possible. We get rid of all those numbers, and then we get rid of these numbers, and now what do we have? 11.890 versus 31. So at a glance, we can see that there was just so much money leaving the market, and so very, very little coming into the market. That's a nice little shortcut. That way you're not sitting there trying to count zeros and say, well, let's see, it's 100,000 million, 31,792,000. And on the other one, it was 100,000 million billion. 11,890,297,086. Come on, man. We don't have time for that in the middle of the day when we're trying to gauge what's going on in the market. So we just come in and, in my own mind, visually, I cut all those numbers off and I say, well, it's 31 versus 11.8, right? Or, like read it just how it looks, and you can say 31 versus 11,900. You know, just kind of a little bit of rounding. Fast, short, sweet, in a hurry, and you can just move on, you know, not be stuck trying to sit there and rationalize all those zeros. Makes sense? So this is just another advance versus decline, though, at the end of the day. I mean, when you kind of rationalize it out, kind of grasp what it is that you're looking at. So we got advancing issues in the NASDAQ. We got advancing issues in the S&P. We got the S&P itself and the NASDAQ itself. What is that? Okay, well, up here in the upper right corner of the screen is a little homemade ETF. Now, Thinkorswim is a really cool product because you can actually combine market symbols. So first, let's just clear out anything that happens to be in here. And we're first going to just go to SPY. All right, so here's SPY. It's a regular SPY chart. But if I go back up there and I hit the plus sign, I can actually add another market to that. So I'm going to add the QQQ. So now I've got a combined chart that has both the S&P and the Qs added together. Now that's pretty cool. From here, we could even add even more. Say we hit the plus sign and we add the IWM. Well, now I've got 3 out of the 4 markets combined. Now, earlier I mentioned that the Dow is a different index all by itself, but we're looking at ETFs. So we could go in and add DIA for the Dow, and now we're literally looking at all 4 markets combined into one candle. What were all 4 of the markets doing Friday? Combined, they were just sinking and sinking. Why is this useful? Well, it's like a little homemade ETF of our own. If you think about something like SPY, what is in SPY? Well, it's the S&P 500. And within that product depth, we can go in and we can ask questions. We can look at the fundamentals of SPY. And we can see, well, what's in this thing? SPY has Apple and Microsoft, Amazon, Tesla, Google, on down the list, right? It's got 30, 50, 100 names, 500 names, right? We just keep going and going and going to 500 different names make up this one product called SPY. Well, what if we chose what was in that? What if we made our own little homemade ETF? Instead of looking at something like SPY that has all of these names in it, even the useful ones that aren't impactful in our market, and we instead decided, you know what, we're going to make our own. What would be a useful collection of names to put in there? Well, I just showed you the 4 indexes, but what about the Fang names? Take something like Apple, and we add Microsoft, and then we add Google, and we add something like Taiwan Semiconductors, and NVIDIA, and Amazon. Now, did you remember all of the names that I just listed? Well, if you don't have to, because once you've typed them in, it actually shows you right there. Apple, Microsoft, Google, Taiwan Semiconductors, NVIDIA, and Amazon. So we don't have to try to remember all of them. They are right there. This gives us an ETF just for the Fangs. There already is such a thing. If we were to go to New York Stock Exchange Fang, there is a NYSE Fang index. Somebody had the same idea and put it together, but this doesn't run in the overnight hours. It only runs during the daytime. And so it may not be overly useful, right? See if they put a description on here. Components. Yeah, it's not giving us, but that's what it is, right? But we can do the same thing, and notice it's delayed price. Well, we don't want delayed price when we're trying to do things in the middle of the day, right? We want activity that is useful and active right now. It gives us valuable contextual information that we can make informed decisions with, not this stuff. So we can make our own, right? Absolutely, we can make our own. So now what we watch and why encompasses all of the different indexes, the different sectors, the advancing versus the declining issue, the money flow, tick, cumulative tick comparison, and a homemade index. I know it sounds like a lot. I get it. And, depending on how many monitors you have, you may not be able to watch all of them at once. I understand. But the more information you have, the better. The more you can see what's going on in the entirety of the marketplace, the better. The more informed your decisions are about the kind of day that we're going to have or the day that we are having. And these are the different products that we watch. So, for an example, if you are not at a computer and you're trying to do all of this on mobile, before you were to take, say, a long off of the lows of the day, you think this is a midday reversal, we're going to rally from here, and the rest of the day is going to be spent in an upside move, say for the last couple hours of the day. You have the time at that point to take a look around and check all of these various products. Obviously, it's going to take a little bit of time while you're getting more familiar with it, but once you've got things consistent in your mind, you just go through these in a very quick checklist. What's the Fangs doing? What's the sectors doing? Which sectors are hot and not? What's going on in the indexes? Where's the bonds? Where's the dollar? Right? And we just go through that list. Short, sweet, quick, and in the hurry. And then we make a better decision afterwards. So that's it, guys. Appreciate your time, and I look forward to seeing you at the next video.